Welcome back. You have just completed 8 sections covering income statement presentation and comprehensive income under U.S. GAAP. This recap brings the entire series together: the standards, the rules, the judgment calls, and the PNJ group workflows that connect them. Let us walk through everything you have learned, reinforcing the ideas that matter most before you apply them on the job. 8 sections. Each one builds on the last. We go from the foundational architecture of the income statement all the way through IFRS comparison and internal controls. By the end of this recap, you should be able to see how every piece connects, from the top line to the bottom of equity and everything in between. The income statement is not just a report. It is the primary communication of how well a business performed. A SC 225 governs its presentation. A SC 220 handles comprehensive income. A SC 20520 covers discontinued operations, and a SC 260 governs earnings per share. Together, these 4 standards define what goes on the face of the statement and in what order. GAAP does not actually require the multi-step format, but practically every public company uses it because analysts demand gross profit and operating income subtotals. The single-step format lumps all revenues and expenses together, adequate for small entities, but insufficient for stakeholders who need to see margin layers. SEC registrants follow Regulation SX norms that reinforce multi-step practice. Revenue is where it all starts. A SC 606 gave us a single 5-step model that replaced dozens of industry-specific rules. The core question is always the same: when has the entity satisfied a performance obligation? Variable consideration gets estimated and constrained to amounts that are highly probable not to reverse, and the principal versus agent distinction determines whether you report gross or net, a decision with real impact on the top line. COGS captures the direct costs of producing what you sell: materials, labor, overhead. Everything else is a period cost and belongs below the gross profit line. Gross margin percentage is one of the most closely watched metrics in financial analysis because it reveals whether a company can price its products above its production costs. Keep period costs out of COGS. Misclassification distorts this critical subtotal. Below gross profit, operating expenses tell the story of how management runs the business. Selling costs drive revenue. G&A supports the enterprise. R&D is expensed immediately under GAAP, no deferral. Depreciation and amortization spread the cost of long-lived assets. Restructuring and impairment charges are where judgment and disclosure obligations intensify. Each category signals something different to an analyst reading the statement. EBIT, earnings before interest and taxes, is the demarcation line between operating performance and financing decisions. Below it sit interest expense, foreign exchange impacts, and equity method income from investees. A critical rule to remember: extraordinary items no longer exist under GAAP. A SU 2015-01 eliminated them in 2016. Any item previously classified as extraordinary now flows through continuing operations as an ordinary item. Income tax expense has 2 components. Current tax is the liability owed today. Deferred tax captures timing differences, situations where book income and taxable income diverge and will eventually reverse. The effective tax rate is the ratio of total tax expense to pre-tax income. Companies must reconcile from the 21% federal statutory rate to their actual ETR, making every major difference visible to readers. Intraperiod allocation is one of the more technical rules in this course. Tax expense is not just a single number dropped into continuing operations. It is allocated across discontinued operations, OCI, and other components, each net of its own tax effect. Continuing operations gets whatever tax is left over after those allocations. The with and without method measures OCI tax effects, and a negative ETR on continuing operations is mathematically possible and valid. Before a SU 2014-08, almost any significant disposal could qualify as discontinued. The standard tightened considerably. Now the disposal must represent a strategic shift with a major effect on operations or financial results. Component-level disposals that are routine do not qualify, and before anything is classified as held for sale, and thus eligible for discontinued treatment, all 6 held-for-sale criteria must be satisfied at the same time. Once a component qualifies, its results come off the face of continuing operations and land below the line, net of tax, as a single amount with detail in the notes. The asset gets remeasured at the lower of carrying amount or fair value less costs to sell, and depreciation stops the moment held-for-sale criteria are met. EPS must show discontinued operations separately, giving readers a clean view of what the ongoing business actually earns. Basic EPS is straightforward in concept but precise in execution. The numerator is net income minus any preferred dividends, because preferred shareholders have a prior claim that must be removed before calculating what belongs to common holders. The denominator is the weighted average of shares actually outstanding during the period. Shares issued mid-year are time-weighted. Get the weighting wrong, and the EPS figure misleads every reader downstream. Diluted EPS asks, if every potentially dilutive security converted today, what would EPS look like? Options and warrants use the treasury stock method, assumed proceeds buy back shares at the average market price. Convertible instruments use the if converted method, add back the after-tax interest or dividend to the numerator, and add the conversion shares to the denominator. Antidilutive securities, those that would increase EPS, are excluded. Always. OCI captures 5 categories of economic gains and losses that GAAP deliberately keeps out of net income, not because they are unimportant, but because their timing or nature makes immediate recognition misleading. AFS securities, currency translation, cash flow hedge gains, pension actuarial movements, and own credit adjustments when the fair value option is elected on liabilities. Know all 5. They reappear constantly in practice. A OCI holds deferred OCI balances in equity until reclassification adjustments recycle them into net income. When an AFS security is sold or a hedge settles, the deferred amount moves from a OCI into earnings. Tax effects must be disclosed. Critically, GAAP prohibits presenting OCI only in the equity statement. It must appear in a statement of comprehensive income, either combined with net income or immediately following it. IAS1 is the IFRS counterpart to a SC 220 and 225. The key structural difference is the OCI recycling split. IFRS separates OCI into items that will recycle into profit or loss and items that will not. Under IAS 19, pension actuarial gains and losses stay permanently in OCI. They never recycle. Revaluation surplus on fixed assets is also permanent. Neither concept exists under GAAP. When PNJ Group consolidates entities reporting under IFRS, a structured conversion process is essential. You identify every policy difference, quantify the adjustments, realign OCI recycling treatment to GAAP rules, recompute deferred taxes, and validate EPS. Each step has a specific owner in the PNJ Group hierarchy. Skipping steps or performing them out of sequence creates errors that compound through the financial statements. PNJ Group enforces a 3-tier review structure for all income statement and comprehensive income work. The transaction manager prepares. The team leader reviews for technical accuracy. The manager approves the final package. No one person controls a classification decision from end to end. This segregation of duties is not bureaucracy. It is the control environment that catches errors before they reach the auditors or the financial statements. The period-end checklist is your quality gate. Cutoff for revenue. Accruals for COGS classification tests for every material non-operating item. Intraperiod tax allocation verified across all components. Held for sale criteria confirmed before any discontinued presentation. EPS numerator and denominator tied to source records. This checklist does not exist to slow you down. It exists because these are exactly the areas where material misstatements occur. Step back and look at the pattern across all 8 sections. Classification is the single most consequential judgment in financial reporting. Whether something is operating or non-operating, continuing or discontinued, gross or net, OCI or net income, each decision changes what stakeholders see and how they evaluate performance. The standards set the criteria, but judgment applies them. That is where accountants earn their expertise. Tax effects do not just live in one place on the income statement. They follow every major component. Discontinued operations net of tax. Each OCI item net of its own tax effect. Intraperiod allocation spreading tax across the full statement. And in IFRS conversion, every reclassification triggers a deferred tax recomputation. Mastering income statement presentation means mastering tax effects at every level, not just the bottom line tax line. The face of the income statement is only half the picture. The notes are where the real transparency lives. Revenue disaggregation, variable consideration roll forwards, discontinued operations line item detail, EPS reconciliations, OCI reclassification schedules, ETR reconciliations. All of these are required disclosures. When the face presents a clean summary, the notes must supply the substance. Know both layers. 3 of the 8 sections we covered involve rules that changed materially within the last decade. Discontinued operations narrowed. Extraordinary items disappeared. Revenue recognition was unified under a SC 606. The IFRS gap continues to shift on pensions, revaluation, and recycling. Financial reporting is not static. The professionals who stay current are the ones who catch problems before they become restatements. Starting at the top, revenue flows from the ASC 606 5-step model. Principal or agent status determines whether the full transaction price or only the fee hits the top line. Variable consideration is constrained, no premature recognition of amounts at risk of reversal. Then costs split cleanly. Production costs into COGS, selling and G&A below. The gross profit that results is the first performance signal the market reads. From gross profit downward, operating expenses by function, selling, G&A, R&D, depreciation, restructuring, converge on EBIT non-operating items land below. Then income tax is not simply applied to pre-tax income. It is allocated using intraperiod rules that distribute tax across every component first. Continuing operations receives the residual. The ETR reconciliation then explains every material difference from the 21% federal rate. Below continuing operations, discontinued items appear net of tax, but only if the strategic shift test is met. Depreciation on held-for-sale assets stops. Then at the very bottom, EPS takes the income available to common shareholders and divides it by weighted average shares. Diluted EPS layers in dilutive securities using treasury stock and if converted methods. Antidilutive securities are always excluded. They would overstate the dilution burden. The income statement ends at net income, but comprehensive income extends one step further. Add OCI, the 5 categories of deferred gains and losses, and you arrive at total comprehensive income, the full change in equity from operations. A OCI in equity holds those deferred balances until reclassification triggers recycling into net income. Under IFRS, pension actuarial amounts and revaluation surplus bypass that recycling entirely, a fundamental structural difference. Everything in this course comes to life through PNJ Group's own processes. The 3-tier review, transaction manager, team leader, manager, ensures every classification decision is challenged before it is locked. The period-end checklist covers all 8 topic areas systematically. IFRS conversions follow a disciplined 5-step workflow, and the disclosure package earns manager sign-off before anything leaves the building. Standards create the rules. Process makes them stick. 5 principles to carry forward. Classification drives everything, get it wrong, and every downstream metric misleads. Tax effects belong to every component, not just the tax line. The notes are required transparency, not an afterthought. IFRS and GAAP diverge most at OCI recycling and pension treatment, and internal controls, anchored in PNJ Group's three-tier review, convert knowledge into reliable financial statements. Thank you for completing the full PNJ Group income statement and comprehensive income training series.